Hello everyone, and thank you for watching this weekly technical analysis video. It's Monday, July 17th, and the calendar will include US retail sales and UK CPI inflation figures on Tuesday and Wednesday respectively. So dollar yen and pound dollar could be important to watch later this week. And I will also take a look at gold because the precious metal has been mainly driven by US headlines lately. So starting first with dollar yen and US retail sales data, expectations are for a stronger 0.5% growth in retail sales month on month. Well, that might not be a huge growth, but it could be the second fastest increase in retail sales this year. So that could be positive news for dollar yen. Nevertheless, the data will need to surprise significantly to the upside in order to boost dollar yen, because investors are already certain that the 25 basis point rate hike will happen next week during the FOMC policy meeting. Now, from a technical perspective, the pair will need to secure a strong foothold around the 138 level in order to retest the 141 key resistance territory, where the 20 and 50-day exponential moving averages as well as this broken support trend line are located. The 23.6% Fibonacci retracement level of this afternoon over here is located here as well. So a decisive close higher could confirm additional gains, likely bringing the 142 resistance area where the price peaked in November and also back in June back into view. A successful move higher from here could then drive us straight into the 144-145 crucial resistance territory where the pair peaked back at the end of June. Now, if we look at the technical indicators down here, well, the RSI and the stochastics cannot exclude the rebound, since the indicators have been fluctuating near their oversold levels for some sessions now. Though the stochastic oscillator is still below its 20 oversold level, and the MACD has just entered the negative region, which suggests that, which makes more downside likely in the coming sessions. Nevertheless, for that to happen, the pair will need to close below 138 and, more importantly, below this key descending trend line at 137.50 in order to meet the 200 exponential moving average and the 2023 support trend line at 136.35 and 135.65 respectively. If we fail to rebound here, then the 61.8% Fibonacci retracement level of 134 could next come into view, while lower than that, the pair may face a faster decline towards the 131 level. Now turning to gold, gold could also face volatility in the wake of the US retail sales data tomorrow. The precious metal is currently testing the upper boundary of this bearish channel, slightly below the 38.2% Fibonacci retracement level of this downtrend over here at 1963. From a technical perspective, both the RSI and the MACD keep trending higher, so that suggests a bullish bias. But overall, the price will need to overcome the 1963 level in order to meet the 50% Fibonacci of 1985. Higher than that, I expect gold to retest the 2000 psychological mark and perhaps trade slightly higher near the 61.8% Fibonacci of 2007. Looking for support levels now, well, the 50-day moving average is currently acting as a strong support around the 1950 level. If that proves fragile in the coming sessions, then gold could move lower to retest the 1939 support region. The 23.6% Fibonacci level is very close to that territory, so a move lower from here could bring the 20-day moving average and the lower boundary of this broken bullish channel back into view. Those are within the 1927 and 1920 region. Failure to pivot here could then press the price towards the 1900 psychological mark, or perhaps lower to toward the 3-month low from 1892 registered back at the end of June. If the downtrend resumes below that point, then the next stop could be near the 200-day moving average and at the lower boundary of this bearish channel seen around 1873. And finally, looking at pound dollar, UK CPI inflation figures are expected to slow down. A negative surprise in the data could add some extra pressure in pound dollar, which closed with mild losses back on Friday after peaking near a new 15-month high 1.3141. If that weakness continues, then we may face some consolidation around the 1.30 psychological mark, where the 61.8% Fibonacci retracement level of this downtrend over here is located, as well as this broken ascending line over here. Not far below that, there is another trend line, a broken trend line, ascending trend line at 1.2922, a break of which could press the price towards the 20-day moving average, and this tentative support trend line at 1.2750. Steeper decline could retest the 50-day moving average and this longer-term ascending trend line at 1.2630. If we fail to rebound here, then the focus will turn to the 1.2535 region, where this long-term descending trend line from 2021 is located. From a technical perspective, the RSI and the stochastics suggest overbought conditions. The indicators have slowed down after rising above their overbought levels, but they have yet to show a convincing downfall. The RSI is still above 70, the stochastic is still above 80, while the MACD remains elevated above its red signal line. So a rebound in the price wouldn't be very surprising in the short term, but for the pair to attract additional buying interest, it will need to close above this key constraining line from September 2022. A move higher from here could probably meet pose somewhere between 1.3250 and 1.33. While higher than that, the focus will turn to the 1.3412 and 1.36 levels, where the price faced some consolidation back in 2022 and 2021. So that's all for this week's technical analysis outlook. Thank you for watching, and wish you have a great trading week.